Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. It is a U.S. holiday, President's Day. U.S. markets are closed. You can sit back and relax at this wide-ranging Macro Monday discussion. We're going to start with the usual crypto flows, which are increasingly becoming pretty dominant in the conversation relative to where we've ever been historically. This is the largest week of inflows notionally ever, and this stuff's getting harder and harder to ignore. Access broadly is not great from what I hear on the street as far as accounts being able to trade this stuff, being restricted for certain reasons. But clearly the early adopters are ready, willing, and able to jump into this stuff, and that has helped flows reach nearly 2.5 billion last week. Most of that, of course, in the United States. One thing that popped out to me this week was the emergence of the Solana ETH relative value trade playing out a little bit here, because you've got inflows into ETH, you've got outflows into Solana, not of equal magnitude, but I think this does speak a little bit to the expectation of ETH strength based on ETF approval speculation. Last year, we saw that flipped. We saw strong inflows into Solana, weak inflows into Ethereum, and every other coin on here irrelevant. Pretty big outflow out of Cardano on a relative basis. Pretty big inflow into short Bitcoin. I wish those people well. And again, United States, where most of that's coming from. If you look at where we are in the cycle, we're about 8 weeks out, April 20th-ish, and we're right on track historically. This is what we expect, plus or minus 75 weeks from halving. We certainly look stronger than we are typically pre-halving. I don't think that's a concern. That may bring the percentage move higher. Heck, maybe we have a global recession and this doesn't play out. Man, would the Bears would love that. History doesn't repeat, but it does rhyme. It's going to be different. It's different every time. The difference maker this time is ETF flows. Calendar for the week is a bit light. Really nothing going on. Bunch of Fed speakers. What do these people actually do? I don't know. But they're talking a lot everywhere. I guess the Fed minutes may be the biggest item of the week, other than NVIDIA earnings Wednesday after hours. And let's talk about cash for a second. I saw this chart from Peter Mallouk, financial advisor. And much like trading altcoins versus Bitcoin, you just have to realize over time, because of inflation, cash is kind of a losing position. Savers do not get rewarded in cash generally, especially when you account for taxes and inflation. It just hasn't worked out, which is why looking at the amount in money markets right now, 6 trillion in money markets, over 6 trillion. Rates obviously at 5.25, whatever they are, thereabouts. That certainly helped push money into money market accounts. And if you're curious, the last time we really had an issue with money market accounts was 2008. The NAV is $1. There really hasn't been problems with that. You can read about breaking the buck and what happened in 2008 and before then. But the question I'm asking myself is, who's in money markets? What is the demographics there? It's usually older people. It's usually people trying to preserve their purchasing power, preserve their wealth. They want little to no risk. They may not understand necessarily what they're getting themselves into based on real rates, based on inflation. And there may be a better option, right? And that's plan B, Bitcoin, of course, right? So I don't necessarily think this 6 trillion is coming out of money markets and into Bitcoin by any means. But when people think like, where's the money going to come from? Who's buying this stuff? That this is part of it eventually. This is extremely slow to react to rates coming up, coming down, but it's something to continue to watch for sure. Speaking of global recession, we've got several countries officially entering recession. UK being probably the biggest, Japan also up there. Germany, based on what I'm seeing, is a done deal as well. Canada also very likely entering recession. And China, I don't really know how we measure that. I don't think we believe them on any of their data, so I don't know if we'll get a real deal recession there, but they're definitely on the struggle bus. One thing to pay attention to with Japan is UJ. And what this all boils down to is this negative feedback loop, basically, because UJ wants their currency at a specific level or less. That's 150 historically. Historically, they've intervened above 150. Intervening to them means selling reserves. What are their reserves? Their reserves are US treasuries, Japanese treasuries. Selling our treasuries brings our yields higher. Everyone else cutting rather than raising rates globally brings the DXY higher, and that puts more pressure on UJ, which puts more pressure on yields, and you can see everything's just sort of interconnected. So just something to pay attention to in the periphery when you start to see headlines about the intervention or whatever they're calling it now. Just looking at the technicals of this, looks like a cup and handle. It looks like it definitely wants to go higher. And I think the question is, how hard are they going to defend this to prevent things from getting out of hand? Just something to watch. Coming off a hot CPI print last week, slightly hot. I'll get into that in the middle half of this, but Trueflation still down effectively. Multi-month lows. They continue to add different types of data points, which is going to jostle this around a little bit. I forget what they added recently, but if you want to look at the categories, if you're curious, you can see all that down here. Directionally, it's done really well. So I have no issues with expecting CPI to continue to come down. I disagree with the 3% people like Bianco. I think we'll see that in the data in Trueflation, which we haven't seen yet. If this starts to curl up, then I think that's certainly more concerning. The Fed's own nowcast for February is up from like 2.84 to 3.06. We've got PCE next week, which is starting to get more in line with where the Fed wants inflation to be. Depending on what they are using for their own criteria, how they want to slice and dice this, we're certainly getting closer. We're getting closer to a target. And that's going to change rate expectations. At this point, I don't really care. We have ETFs on the Bitcoin side. Rates coming down benefit us. Rates being held at this rate eventually benefit us because we're going to bankrupt ourselves. We're going to bankrupt our future, and that's going to push more people into Bitcoin. Okay. We cannot perpetually pay the debt burden that we're paying at the rates that we're holding this at. It just doesn't work out. 34 trillion with a bunch of debt being rolled this year, next year. Heads we win, tails they lose. It's that kind of situation here. 3 cuts, 6 cuts, a 50, a 25. I don't really care. Doesn't matter to me. But I do think eventually rates come down because inflation based on Fed's metrics is getting in line with expectations. And Goldman still says 5 cuts. So, hey, I'll take it, right? I'll take any cuts. Whether or not we need cuts is the real question. Who are we cutting for and why? Based on what, right? Should we be cutting with stocks at all-time high? Should we be cutting with the wealthy being wealthier than they've ever been? Where do we really want XYZ data print to be? I think the Fed has had trouble answering that question. And Goldman also saying here, the next CPI and PPI prints are very important, right? Every next print is more important than the last. Looking at reverse repo, this is kind of a ticking time bomb from the debt situation. We are paying short-term debt, purchasing treasuries with reverse repo, basically. Money markets are sort of doing the job for us. This has gone from over 2 trillion to under 600 billion. So likely sometime by the end of the quarter, this will get drawn down to a point where we just sort of flatline. Then we may see yields have a little bit of a party. We'll find out, right? But it's definitely something to keep watching. Once this runs out, who's going to start buying our debt? Our long-term debt, our short-term debt? Does that mean yields go higher? Back to the Japan conversation, does that amplify yields going higher? Super fun stuff. Looking at non-reverse repo, major central bank balance sheets. Again, back to this global recession conversation, we've gone from the hiking cycle to probably leaning towards a cutting cycle. As a central bank, if you're cutting, you probably don't want to continue your QT program. Whether or not you reinitiate a QE program is another question. But the Fed balance sheet levels here may have bottomed, which goes back to the liquidity conversation. If we are increasing liquidity, that helps risk assets. That's a huge boon to Bitcoin, huge boon to crypto. The Fed has already hinted at slowing the pace of QT. I don't know the status of the other central banks, but I do know, China's talking about throwing in a considerable amount to stabilize their markets. And the real problem here is once these central banks bring all of this onto their balance sheet, they have a very hard time taking it off. And that's good for Bitcoin, right? Bitcoin exists partly because of central bank malfeasance, and that's why we're here. Looking at GDP on this side of the pond, 2.9 estimate, not bad. Look, we'll take it. It's not recessionary levels just yet. We look good. If we look at the yields and we look at unemployment, still inverted yield curve, no immediate issues, right? We can talk about this till we're blue in the face, but ultimately until this uninverts, I have personally no issues with being fully deployed. I'm not Bill Gates. I'm not Tommy Tuberville. I'm not Drunken Miller or whoever else has submitted their 13F to adjust their portfolio. I think that time will come, and I think it'll be probably around the uninversion of the yield curve. If we look at the yields, though, from week to week here, the orange is this week right now, and you can see the belly of the curve is rising here. And again, back to this Japan, QT, whatever conversation, reverse repo, right? All this stuff feeds into itself. Who's going to buy all the debt we're issuing? How will that affect the yields? Just something to think about. Something terrifying to think about. And, we've got Bianco out here blasting at the Bitcoin ETFs on one side. And then on the other side of his mouth, he's talking about how bad the bond market is this year. And it's, I love Bianco, don't get me wrong, but just like Jim, read the room here. People are looking for something that goes up instead of down, right? Like it's that simple. And the worse the bond market does, the better that is for Bitcoin. It just is. It just says, yeah, this is why we're here. And it's not looking so hot right now. If we look at TLT, the worse TLT does, the worse the banking industry does, the worse banks do after the BTFP program ends in mid-March. I mean, all this stuff is just aligning to fireworks by Q2. On trend, this continues to be very bearish on a high time frame. So I certainly wouldn't want to be holding on to this, looking at this chart, thinking, yeah, this is, does this look like a bottomy chart to you? Not quite yet. If this gets into the weekly cloud, this is another story, but not really. Regional banks taking a downturn since that New York Community Bank commercial real estate issues doesn't look terrible, but the cloud would suggest if this breaks down out of the cloud with a bearish TK cross, that is a reinitiation of bearish momentum. So I certainly wouldn't want to be sitting in regional banks, mainly because of commercial real estate, for the remainder of the year. Getting back to the CPI print, if we look at what's in that data print and we look at how things are calculated, there's rent, and then there's this thing called OER, owner's equivalent rent. And what they literally do is they survey people, ask them this question, and then that gets baked into OER. Kind of bizarre, but that's the way they do it. It's funny that they don't use like some sort of automated process based on online data, kind of similar to inflation. They're literally calling people, asking this question. The data in CPI is also delayed 3 months, 6 months, which is why things were maybe a little hotter than they were based on expectations. As Goldman says here, they call it a January effect. Insurance way up, car insurance way up. So there were definitely some troubling signs in CPI, right? Then a week later, they have this headline, OE, are you serious? Which is hilarious. But again, they're kind of challenging whether or not this strength is going to last. Something else that many people have mentioned, are we seeing OER rise based on immigration? Certainly possible. Based on the calculation of OER, there's some argument that this is just previous months working its way through the ecosystem. Ryan had a good chart here, Dietrich, talking about the difference here. You can see rents coming down with OER on the rise here. And what would account for that difference? I'm not exactly sure, other than potentially immigration, potentially this lagging data component that's working its way through the system. Wisdom Tree also had a good graph comparing real-time shelter versus the BLS shelter component. And again, you can see the quickness at which this got picked up versus now, right? And there's definitely a difference in what we're looking at. We all live here. Everybody wants inflation to be down. I don't think that's a question, but it is a question of what data are we using? How are we collecting it? And then how are we using that to guide policy? Because we do risk potentially being too tight for too long and tipping the United States into a recession. Here's another great graph talking about the difference between OER and rent. So I think you get the point, but this played a big role in the CPI print being above expectations by 0.1%, which was enough to make the market very angry on that day. And as Jeff says here, home prices could go down for all of 2024 and OER would still spend the year going up based on the calculations. So this tells me in the moment, immigration may not be an issue down the line it might be as far as what this data is showing us. Immigration, clearly a problem, but I think people are using that problem to sort of say, it's this, it's that, pointing to other stuff. Then there's Jim, who kind of disagrees with this idea that inflation's coming down. There's this base effect. Onshoring, nearshoring, reshoring is causing inflationary forces to keep inflation higher for longer, which means the Fed's going to stay higher for longer. I'm just looking at the data for Trueflation. That's all. I don't see it in the Trueflation data. I don't see it in the real-time data. I see a lagging rent component, and then I see what the CPI is. We still have the macro doomer crowd, macro elf classically among them, talking about how Supercore is on the rise again. The good news is we've got 4 CPI prints between now and June. So we got plenty of time to him and haw about this a little bit more as we get closer to those dates. Let's talk about markets. In the back half of this video, lots of discussions about a few charts I've seen this week, this being principal among them, looking at the different types of election year seasonality. Is an incumbent running? Is it an open field? And then 2024 in the pink here. General seasonality would suggest a decline from here until Q2, which I could see. I could see that on the table. We don't look like all other election years based on how strong we've been. We certainly don't look like the open field, although there's some argument that if you think Biden's going to step down, maybe it is an open field, right? I don't know. So it doesn't quite fit the pattern to me yet, other than, sitting president running, right? And maybe the NVIDIA earnings this week will be the top on Wednesday. I've seen this chart about 20,000 times as well. It's a bit of a chart crime. Bull markets are correlated, but it's just funny. Again, it matters where you're seeing this data presented from. Are these people pro metals, pro antibiotics and canned goods, right? Or are they pro risk, pro crypto, that sort of thing? Crescat leans in the activist metals category, so that kind of tells you all you need to know. I saw this chart as well about 10 times this week. Another chart crime of its own, comparing the current AI bubble to previous bubbles. Bitcoin, of course, is on here. ARK, a lot of that was GBTC as well, to be clear. They don't own GBTC anymore, but they did at that time. And what they're not showing, as Low Strife points out here, the several quote-unquote bubbles we've had. This is probably the only asset through history that we've seen the quote-unquote bubble reinflate and deinflate over and over and over again. And unlike these other bubbles, that declined significantly, why are we still inflated if this is a bubble, right? Is this just a decade-long bubble? Is this a 20-year bubble that we're going to experience here? Or is something going on that's kind of too hard to ignore? Chart-wise, it's still a little bit of a waiting game. Is Legacy overbought? Is Legacy ready to roll over? Is Legacy going to calm down a bit? A lot of that conversation kind of revolves around DXY dollar strength. Is the dollar going to regain strength on a relative basis because everyone else is cutting? Again, another thing to think about. As Michael Cow puts it, dollar wrecking ball, right? Emerging markets certainly don't want to see the dollar higher. Everyone who's in a global recession or relatively a global recession doesn't want to see the dollar go higher. Crypto doesn't want to see the dollar go higher. Technicals for this would suggest continued bullishness based on trend. It's in a very broad range, but it is on the bullish side, bullish half of that range. So we'll call this angry but bullish on the DXY side. S&P kind of screaming up here in a rising wedge into a yearly pivot. Not typically something you'd expect to just blow through that type of resistance. It would make more sense for me that the S&P slowed down a little bit here, the Qs slowed down a little bit here, consolidated around 5,000, consolidated around 430, 450 before trying the next leg. You can see here on RSI on the Qs, you do have a rising price with flat peaks in RSI, so that is a weak bear divergence. This isn't like screaming sell, but I wouldn't want to be adding to positions up here broadly on either of these charts. I'd want to wait to see some consolidation. In the low caps in the Russell 2000 IWM, trying its darndest to get above the weekly cloud here on trend. SMCI has been a big part of that. Likely as rates come down eventually sometime this year, we will see IWM start to do better. But the better this does relative to tech, the weaker the bearish argument gets of overconcentration. If tech can slow down or pull back without the entire market getting obliterated, that certainly yields a weaker bearish market because everything's been focused on Mag 7, NVIDIA chips, even SMH, which I don't have up, but NVIDIA to me looks like it's ready to roll over. I have no clue what earnings are going to be. I have no clue about any of that stuff. I would just be very careful up here, and I don't think that's a secret, but if I had to put a blind bid on this, it would be 600 based on the daily Kijun. And as you lose momentum after a big move like this, you do get this TK line separation. Things start to flatten out. And it says you're probably close to a consolidation period, very similar to July, August 2023. So I would definitely be careful with that one. Microsoft pulling back a little bit as well. Almost hit the cup and handle target at 430. Probably will. It still looks fine. I don't have any issues there. Amazon almost hit my target at 180 to 200. I think it'll get there eventually. I'm not really concerned. That would be a new all-time high. We've got Uncle Jeff selling, what was it, like $6 billion total over the past 2 weeks. To me, these look fine in the moment. Meta, I don't really know what you do with this one. It's at all-time highs, just sort of sitting there after a parabolic advance. Not something I'd get excited about buying all the way up here, but it looks fine. Google starting to pull back a little bit. Very noisy, potentially forming its own massive multi-year cup and handle up here. Still remains bullish on the weekly trend. Netflix kind of similar to Meta, just kind of hanging out at this high. Not something I would get excited about buying personally. Apple looks extremely weak to me, especially relative to the others. It has a bearish head and shoulders here. And whenever I see Warren Buffett losing money, I get happy. So send that down to 160, 165, whatever that is. The 200-day moving average is up here. The daily cloud is up here. So there are other trend reasons why if this breaks down, you're certainly flipping from bullish to bearish. The only thing that looks worse than Apple in the Mag 7 is Tesla. Tesla's been below the weekly cloud for a bit now. And this entire structure, this multi-year structure, could be a diamond top. You could probably draw 15 different chart patterns up here between some sort of inverted head and shoulders, some sort of diamond top, some sort of head and shoulders. There's all sorts of stuff you could draw. I'm more concerned with this triple top here being below the weekly cloud. Now it did have a low time frame inverted head and shoulders that I pointed out last week that did work out. I didn't play this. I should start playing legacy stuff a little bit more, but this looks okay. It looks like it wants to retrace a little bit more. Maybe buy the neckline here at 195. But so far so good on that bounce. Coin had great earnings last week. At this point, it's almost hit the weekly cloud. It's been a journey from Q4 last year. Really quite quick on this very big inverted head and shoulders, complex inverted head and shoulders, if you want to call it that. Edge to edge move. This may be some sort of cup and handle, up here. Maybe it retraces to like 167. And the breakout trade is the next trade to take on coin if you trade this actively. But trend-wise, this looks fine, right? This looks ready for a move mid-year above 200. Certainly don't expect earnings to get weaker. Don't expect ETF custody to get weaker in the moment. And they also have true value, fair value, FASB rules coming up in the next earnings. So coin to me looks like a great outlook for 2024. The real question for all this stuff is relative to Bitcoin. Even relative to Bitcoin, coin looks pretty good. Again, this like gross looking complex inverted head and shoulders, white coffee in range. I don't know, whatever you want to call this, but trend wise, it's trying to get above the weekly cloud as well. So it doesn't look like a horrible play relative to Bitcoin. If you're looking for opportunity cost or relative value there. Hood broke out last week as well on the range. This looks fine. Send this to 50. This looks great. I mean, it's done nothing for 2 years. You're having retail slowly come back to this crypto volume, slowly picking up. We probably have more IPOs coming down the pipe. And trend-wise, into the second half of this year, that's when you'd expect bullishness. So is it a little bit early? Probably. But I still like this chart for the rest of 2024, especially if crypto does well. I did a whole video on the miners this weekend. WGMI is a bucking Bronco. It is the miners ETF from Valkyrie. It is a rough buy and hold. Trend-wise, it looks okay, right? It is above the daily cloud. Daily cloud is bullish. TK cross is somehow bearish here. Just it goes to show you how quickly this move has happened. You've got a case for cup and handle up here. I don't doubt that this goes higher, but again, the question is on a relative value basis, is this in a range? Does it find a local top relative to Bitcoin up here, or does it keep going? And that's something, if you're trading this heavily, you should probably pay attention to, just based on relative value. One thing I mentioned in the video this weekend is if I was trading this actively, I'd be watching on the 4-hour. The 4-hour cloud has picked up these trends really well. It has picked up the broad bullishness and bearishness, and right now it remains bullish. So this looks okay. So I think broadly we could see some pullback here in legacy. I think crypto is fine as long as we see inflows, Bitcoin specifically. And in the periphery, I'd be watching for what happens with UJ here and how that affects yields on the long side. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.